3 decades in lending. Started my freshman year of college as a originator for a small brokerage. I ran as an originator for 5-6 years, and then started a brokerage that had grown to one of the largest in California. That was late 80s, early 90s, and then transitioned to a mortgage banker role, which offered Fannie, Freddie, and Ginnie. And that was like mid 1995, 1996-ish. And then ran that from 95, 96 through acquisitions and the whole mortgage meltdown to 2016, at which time I took over in running CIVIC. So the purpose of me sharing that with you is it's lending is what I know. It's what I'm passionate about. I think I approach the business from the origination perspective, that as a boot on the street originator, and not from some ivory tower, highly educated, read a whole bunch of books on what it takes to be a good mortgage originator. It's really more through the hand-to-hand combat of what works and what doesn't, and trial and error, and then double down on the stuff that is working and pivoting on the stuff that's not. We here at CIVIC have a little over 2,600 mortgage brokers that are approved with us. I believe we have 130 some odd, 150 that were invited, 130 that'll be joining us on this call. So, you know, it says something about you that you were hand selected by our account executives to join us. So thank you for that. And Ben, why don't we kick it off and let's get going?
Yeah, absolutely. So, you know, obviously, Bill, a lot's happened over the last 90 days that has changed a lot of the things in our industry. I think everyone's just curious as, you know, what the heck actually happened. So if you could kind of give your perspective of that in your own words, I think that would be great for our broker community.
Yeah, I think the biggest misconception was that many compared this to the credit crisis. And having lived through the credit crisis, what I could share with all of you is it couldn't have been further from that. The credit crisis led up to irresponsible lending that most of us had participated in. There were 100% financing options to $2 million loans with FICOs under 600, no income, no asset, and a wink-a-dink, and they get a loan. If they wanted to do that twice or 3 times, they'd get financing for that. And everyone was borrowing based on appreciation for tomorrow. When that stopped and Wall Street took a look behind them, they basically had a wake of stuff that was heavily undervalued. And then there was the whole strategic foreclosure and all that around that really created a crisis that lasted 6-7 years and wiped out a great majority of the industry. This was not a credit crisis. This was a value of loan crisis. And I'm going to narrow down that answer, Ben, to just our space, right? Just to the business purpose loan space. Basically, when you as brokers submit a loan to a banker like CIVIC, we have a number of different outlets for that loan. You can sell that as a whole loan trade. You can sell that as a pass-through. You can do a securitization. But all of those vehicles have some form of value higher than par. And it's that value higher than par that allows companies like CIVIC to grow and expand with our brokerage community and offer some of the products and prices that you guys had seen in the space. In a 48 to 72 hour period, that value of that loan dropped 12 to 15 points. No rhyme, no reason. The Smith borrower that was paying before COVID hit is the same Smith borrower that's paying after COVID hit. Real estate market didn't collapse. Wasn't anything to do with credit. There were just no bids in the secondary or capital markets for that paper. And paper that might have been trading at a 102, all of you know what that means, 2 points above par, was now trading at high 80s, low 90s. And so when you think about that, what happened overnight was lenders, our size, mid-size, smaller size, they got margin calls. And if you didn't have that paper pre-sold or an forward commitment, you had to meet those margin calls. And I'd done a video a short time ago, Ben, but basically those people fell into kind of three quadrants the way that I saw it. It was the quadrant one, which was larger originators, bigger capital bases, had to retool and reposition themselves in the marketplace to make sure that new originations could be sold at least a par, not at a negative. May have had some margin calls and met those margin calls. And we've seen some of those companies exist today. Then you had the mid-sized companies. Those companies all went on pause. I guarantee you at least half of the brokers on this call had a lender where they had a loan submitted and they got that we're on pause right now. We're, you know, the checking is talking to the savings and we're trying to work this out, and, you know, we're going to be at the market soon. And some of those companies will survive and some of those companies won't. And then you had the others that just got completely wiped out. We're hearing numbers on Wall Street that is as high as 70%. And what does that mean? That means all the lenders that acted as lenders from small, medium to large size today are no longer originating. And so I think it did expose a whole bunch of highly levered lenders that put themselves out in the marketplace a certain way. And it also allowed, you know, a little bit of the hard money lenders to come back into the space because of where the market is today, Ben.
Got it. Thanks, Bill. So you mentioned in that piece there that, you know, pretty much every broker on this call has probably had a loan that they submitted to a lender and then found out halfway through the process that they were on pause or that that product wasn't available, or, you know, some sort of speed bump like that. So I think it would be reassuring for our broker community to know, how can they be comfortable sending their loans to Civic?
So the first thing is we have a substantial balance sheet, not substantial balance sheet like 5 or 10 million, substantial balance sheet like north of 100 million. And the equity we have in this business is substantial. We have warehouse capacity that exceeds $1 billion. And so why is that important? It's important in times like this when you have a market dislocation that we're not cutting bait and going on to a new business. And so I think it all starts, if you're a hot dog salesman, you guys get tired of me saying this, but if you're a hot dog salesman and you don't have any hot dogs, you're not a hot dog salesman. And if you're a lender and you don't have access to money, then you're not a lender. So you have access to money based on a balance sheet. And if you don't have a balance sheet, you don't have access. And if you don't have access, you're not a lender. And I think first and foremost, our balance sheet stands high and above most. We've had uninterrupted lending. Yeah, listen, we had to look at the marketplace the way the market responded on Wall Street. And so you saw our leverages drop down on average about 7%. And you saw interest rates go up they went up as much as 200 basis points. And I think they've settled down right around 150 basis points. What I could promise everyone on this call, that came with much resistance. All of our counterparties, and we had about 8 of them on Wall Street, all told me at the time that any loans originated under 11% would be originated at a discount, which means if you got an 11% fix and flip loan at a 70% LTV, and I took that loan and I tried to trade that loan on Wall Street, they would not give me par for that loan. I had a very difficult time in my position getting my arms around that because I still believed that the 8.5% and 9% loans that we did end of February, first few days of March, were still performing, still good loans. So how could those loans be at a premium and 10.5 be at a subpar? But it doesn't matter what I believe. It only matters based on what's trading in Wall Street. And what I could tell you, even to this day, right now, as we sit here, June 10th, you couldn't sell an 11% at a premium today. You couldn't do that. So like, what have we done? Well, we are aggregating loans. We are selling loans on a pass-through. So it's really more of a clip and strip model. And we're looking for that securitization market to work its way back into our space. What I would tell you is operationally, we're 300 people strong. I think through the entire COVID pandemic, from beginning through where we are right now, that staff number was within 3%. We continue to offer our full suite of products, which is uncharacteristic in our space. And I think most of that is centered around quality, quantity, consistency. We do good loans that perform. We do a whole bunch of them, and we do them month over month. So we do get, some preferential treatment from our counterparties on Wall Street.
Got it. Thanks, Bill. So you mentioned, the different types of lenders that are in our space and the different relationships that they have with Wall Street, and then, different types of liquidity and capacity. Can you kind of give a breakdown of the full scope of lenders that are out there today in the private money space?
Yeah, so I think it's really kind of like 4 buckets. You have the large aggregators or larger companies such as CIVIC. You could call them the survivors or the thrivers of the pandemic. And we're not the only ones out there. There's a small handful of others. I think the second one is, I call them posers, not to be mean, but just to be honest, right? If you have a full suite, or you have the ability to deliver financing to the broker, to the investor community, then tell them what you can deliver. And don't wait for change to happen on the Wall Street side of the equation before you're out in the market slinging loans. Right. So I think that's kind of a scary part of our business right now. Then you have the country club lenders. That would be like, let's say me and you, Ben. If we were high net worth individuals and we had $5 or $10 million extra, and we wanted to lend that money and earn some reasonable ROI. Everyone on this call knows a few of those lenders. They're out there, and I think if anyone were happy about what's taken place in the pandemic to our space, it's probably them, because rates have come closer to where they were lending and leverages have come down closer to they're relevant right now. And then you got fund managers, and they're a little bit bigger than the country clubs, but they've maybe gone out, raised 100, 200 million, and then they've put their fence around how they'll lend. And so they'll have a little bit more runway than the country club lenders. But again, they're looking for higher yield. They're not trading that paper. It's simply, once they lend up to 150, they got to go raise more capital. I think that's really the 4 that are out there right now.
Right. Yeah. Thanks for that breakdown. So Bill, I know that you're constantly in contact with Wall Street and secondary, market partners. When you're on those calls with them today, as compared to 90 days ago, what is the sentiment like on those calls? Is it doom and gloom? Is it sunshine and rainbows, somewhere in between? What's the vibe on those calls, this morning?
Yeah, I would say overall, Wall Street is a half full entity, not a half empty entity, not a half full. And what I mean by that is, when this thing first happened, here were the questions that were coming out of them, right? This is why loans had no value. Here's the reason. Unemployment's going to reach 50 million. What does that mean? COVID's going to wipe out a third of the community. Who's going to be left to borrow? Real estate values are going to plummet to levels that we haven't seen since the credit crisis. How should we be thinking about loan to values? The stock market's going to go below 10,000. Deferment, it's going to take over that part of the market, and apartment buildings, all the multifamily and all the renters in the renter market. No one's going to have to make payments on a 1-year loan for 3 to 6 months. And how should we think about that? And so all this noise creates a pullback where they're looking for other places to have their money work. And I think here's the reality. I don't believe anybody on this call would argue this, but here's the reality of what we've seen. The stock market just hit a high. How in the hell is the stock market trading at 27,000 points when we still have 40-some million people unemployed? I think part of that is that the market believes that a good portion of that 40-some odd million, 75% of them, will come back to employment quickly as we go through these different phases of the unwind. And then the other 25% of that 40-some odd million will bleed in back into the economy. So the market is telling us that they factored that in. That's number one. Number two, the pandemic feels more in our rearview mirror than front facing. And so with that creates some form of confidence. I'll tell you, Wall Street this week started coming back to their buildings. And New York was the epicenter of of chaos and problems and high numbers, and we know a whole bunch of people that worked at some of the big financing entities that had those issues with their employees. So they're now starting to come back. So that's created a little bit of confidence. We had about $2 billion of that 8.5%, 9% paper that sat dormant, that got swept off of lenders' accounts at a discount, margin calls. That stuff is starting to trade away at a discount, which kind of opens up that vacuum a bit. The deferment de facto, that ended up being a big nothing burger. I think we saw organizationally about 8 or 9% of the total requests get approved. And to get approved, you just had to show hardship. It wasn't like a formal underwrite. Show hardship, you get approved. Well, people weren't, everyone saw in the news, Ben, hey, just send an email or place a phone call and you get approved. And so, of course, a whole bunch of people tried that. We had over 800 of our customers do that. And then when you say, just show us some sort of support, that was a nothing. And so I think all this skepticism and them being scared has created this open hole of we're not stepping back in until they started getting some answers. And they're starting to get answers. And we're seeing players work their way back in the market. It's why we improve rates 50 basis points. It's why we improve leverage 5% on one of our products. It's why we're looking at the bigger loans again, right? And so I think my feeling is sooner than I originally thought, but not tomorrow. Not like everyone's chips all in. They're still tiptoeing their way back into the water. I think it feels a lot better today than if you would have been on a call with me a month ago. A lot better.
Yeah, thanks. That's super helpful. I mean, it's understandable when this whole thing hit that, the pendulum kind of swung back the other direction, right? And maybe it swung a little bit too far. And it's good to hear that we're having optimistic conversations, on the secondary markets as opposed to the ones that I know we were having, 60 to 90 days ago. So that's great. So we've talked about financial markets. We've talked about the stock market. We've talked about unemployment numbers. What about the housing market, Bill? I mean, even pre-COVID, we were talking about, there's thinning margins in certain markets on flips and things like that. Where do you see the housing market today? Do you still think that there's opportunities out there, in large numbers for our real estate investors and our broker community?
Yeah, and I don't know how many people on this call know this, but CIVIC's parent company is the largest fix and flip aggregator in the space. They've purchased, fixed up, and sold over 40,000 properties. So we have unbelievable market reference into a whole host of different counties and states throughout the US. And here's what I'll tell you as it relates to that, and then I'll go into the iBuying market in a second. But as it relates to the Wedgwood optics, for first-time buyers, so that price range, they're achieving 102 to 104% of list price. Multiple offers, no concessions, quick turn times on their escrow. And just by way of reference, they have about 2,200 homes currently in some form of either rehab or escrow. Just so, this isn't like a small little sampling. This is like real reference in the marketplace. So that's good news. The other side of that is the first buy up. So after their first time buy, people that are buying their first buy up, that is also holding in or around list price. It's when you get above that in the bigger properties that they're seeing the pullback. We're here in the South Bay in Manhattan Beach, and some of those bigger properties, we've seen 7 to 10% pullback on some of those list price or what they're actually trading at. And I think that's probably right. I also think that there's a tremendous opportunity for our investors in this whole iBuy movement. So you had companies like Zillow and Open Door and these sort of firms that were tech companies that got into the real estate world. And the model was a very, very tight band, meaning they advertise a way to circumvent the realtor so that the seller can go directly to them. They're going to pay cash. And they're going to buy that property, and they're going to put paint and carpet on that property, and they're going to sell it at a small gain. That's kind of the model. Model hasn't really worked quite the way that they thought they would. And now what's happening is The properties that they own on their balance sheet are getting margin called the same way it would as a lender's. And so that is by the day. So if they have those properties on their lines for 60 days and it goes to day 61, they might have to have a 5% equity call and then another 5 and then another 5. So what that means to all of us or our investors is there's tremendous opportunity at buying those properties at a discount because they have to get those off their shelf. I also think that aligning yourself from a broker perspective with those form of either iBuyers or big aggregator purchasers, such as like Wedgwoods, present opportunities for the investor, similar to what we're doing, Ben, and we could talk about later, as properties work their way through REO. I think that real estate on the smaller end is holding. On the upper end, probably a little bit of squish there. And I think that the iBuyer world hasn't played itself out, but it's not going to end good for some of them.
Yeah, it certainly seems like the higher end markets are pulling back a little bit. I think you mentioned 7 to 10%, but it seems like the lower to mid level properties are holding really strong with multiple offers, and it seems like the market has held a lot stronger than what people first thought was going to happen. Back in mid March, late March, when this whole thing first started.
Here's the other thing too, Ben, just to point out, and I think this applies. Like if there was a lesson learned in all the years I've been in the space, this is the one I would tell all of you. In times of chaos, the pandemics, the credit crisis, and all the other things we've lived through, there is a flight or fight approach that us as originators take, and it's all around us. And you see many people close up shop and redirect their energies or efforts into another channel, or you see some of us hunker down. The ones that hunker down will thrive, and it's the exact same way in real estate. I can tell you because Wedgwood is going to the auctions that are still taking place. They went to what they call in Texas. I don't know if we have any Texas brokers on the call, but if we do, you guys know what Super Tuesday is. They have their auctions one day a month. It's the first Tuesday of the month. They call it Super Tuesday. We bought 26 homes the first Tuesday of the month, 26 through auction. That's substantial. You know why they bought 26? Because nobody else there was buying. Why is nobody else buying? For all the reasons I shared with you 15 minutes ago. What about the stock market? What about unemployment? What about the pandemic and riots and all this stuff and all this uncertainty? I'm scared. I got to hold on to my cash. Well, for the people that step forward, there's opportunity there. And I think for those on this call that are more half full and not half empty, unbelievable opportunity. Our company, Civic, we're doubling down on our marketplace right now. We think that as other people have exited, it's an opportunity for us to expand channels and states and opportunities and offerings. And so, that's what we're going to do.
Yeah, I think that fight or flight mode that you kind of talked about, Bill, is really similar to what, we saw back in 2010. I mean, everyone was dropping out of the market. Nobody was buying anything, but the few people and the large REITs that really did step up and buy a ton of properties, I mean, they made a killing. So I think it's really, similar in that regard. All right, so we've talked about what's going on in the industry. We've talked about, the housing market. We've talked about all that sort of stuff. I think we'd be remiss if we didn't, give our broker community some insight on what truly is the Civic advantage. Like what ancillary advantages are there to them bringing their clients to Civic?
So without being redundant, look, we lent yesterday, we've lent uninterrupted through this pandemic, we're lending tomorrow. So we have a very, very, very large capital base. And that's just important because you want to know, as you're bringing in your valued investors into the fold, that we're going to be able to do what we're telling you we're going to do and what you're telling your customers that you're going to do. We have a lot of meat on the bones. I mentioned earlier, we have 300 plus people. Why is that important? Because so really, if you think about it, I think we have 80 originators and 220 support staff. On an industry that generally takes 5 to 10 days to get a loan in through the system and close. So that is an awful lot of support staff to serve the brokerage and investor community. I think it's important. I think the number one thing for me, Ben, when I joined Civic, I came from a space on the conventional side where an eighth of a percent on the rate or an eighth of a point separated about 5,000 different lenders nationwide.
Yeah.
And so if you're going to sell yourself on points and fees, you're going to get your head taken off. And so how do we act different? How are we different in that space? And our thing is our exaggerated commitment to partnership. And to me, it's not just offering loans and closing on time. I mean, that should be the expectant, right? It's we have a nationwide discount with Home Depot. How did we get the nationwide discount with Home Depot? We spent over $100 million a year on developments and renovations of properties that we have been a part of. So all we did, think about this, all we did was we took the biggest discount in the nation that we had upstairs, and we said we want to give a code and give it to our brokerage and investor community so they can piggyback off of ours. I mean, it doesn't get enough attention, but when you think about it, no one could have done that by themselves. And so for us, it's not like, no, it's ours, we're going to keep it. It's like, no, this is a differentiator in the marketplace, share it. So that was big. Our Maverick design, if we've done 40,000, we know that a gray walls on a blue house is not going to work in Fresno, that maybe almond white is working, or maybe bricking is selling quicker, or maybe linoleum, not shag carpeting, or whatever those little angles are. So we share all that information that we get in real time with our investors and brokerage community. Our back-end marketing. So our whole thing has always been, we have like 13 people in our marketing department, not to serve our AEs, but to serve our brokerage community. White label them, make them look better than they could have made themselves look in the community. Give them all the resources without them having to go hire all the people. So I think that whole approach is valuable. And I don't even know how you could put a dollar amount on it. If anyone on this call hasn't taken advantage of that, you got to. We don't charge you for it. You should just take advantage of it. Raise your hand and say, I want to know more about white label marketing. We have a trigger protection program. So what happens is we know when a loan's come into maturity inside of 90 days what that is. So our AEs are going to reach out. Hey, the Smith borrower is coming due. Let's contact that borrower. Let's get in front of it, right? The whole customer for life, not do a deal, get your commission and on to the next deal, right? Hold on to that customer all the way through so that if you get that takeout or you get that next fix and flip or you get that rental opportunity, that they're going to do it with you. And then the REO opportunities. It's something that Ben, Jack, and Whit have worked on years in the past, and we're perfecting it better. And really the idea around that is we're lending to thousands of borrowers, and everyone on this call tries to make good decisions so that the borrowers do what they say. They're going to pay on time. They're going to pay us off at maturity. And not surprising to anyone on this call, it doesn't always work that way. Jimmy Smith or Billy Jones doesn't figure the market correctly or the rehab correctly. They get themselves in a jam and that loan goes bad. And we have to take it back. And then we have to either rehab and sell it in the marketplace or offer it as a wholesale to our brokers. Well, that's what we're doing right now. I think out of almost 4,000 loans, we have 72 that have been in some form of REO. And so our new movement is let's get those, give them 5 days, give it to our brokerage community. And if you have an investor, then that's a value add that you've brought to them. Or if you guys are also fix and flippers and you have an opportunity to get that. And if it doesn't hit in 5 days, then we'll put the energy, the money, and the marketing in, and we'll do it ourselves and then and let it go out the back end. But at the end of the day, the thing that keeps me up at night is how can Civic continue to bring more value to the brokerage community? So when you're posed with an offering that's the difference between an eighth or a quarter or 1 day quicker in turn time, that you're going to look at the whole body of work and you're going to say, I'm committed to the long-term relationship of Civic and not, I got a grinder that just entered the market offering some, skin back rate or a fee, and I'm going to go with them. And I like that because it keeps me on my toes, everyone, and it makes me think about tomorrow and not just kind of celebrate whatever awesome thing we think we did yesterday.
Thanks, Bill. Yeah, I think along with the Home Depot discount, two of the best benefits that we offer to our brokerage community is that REO list, making those available to their customers. And then also the maturity, notifications that we do when a broker has done a loan for us a year ago and that loan's about to mature. We're essentially sending them free refi leads, right? This note's about to mature. Call your client, see what their plan is, and see if we have a solution that we can offer to them that makes sense. Awesome. So out of respect for everybody's time, I think I've got some really good questions here, so I think we'll jump into that if that's all right with you, Bill.
Yeah.
You covered a little bit of this, but I think most of our brokerage community understands what happened and why we had to pull back on leverage a little bit and why rates increased a little bit. What do you think has to happen in the market to get back to the old normal, if anything? What triggers that?
I don't think it races back, right? Wall Street is really, really, really good about taking and really crappy about giving. And ultimately, these things are settling there unless you're borrowing from a country club lender or a small fund. The loan has to have value. And so the leverage thing, when you think about it, there is still some unknowns. Like, yeah, the stock market's good and the deferment was a big nothing burger, but there is still 40 some odd million people unemployed. And just because Bill Tessar on some Zoom call said that 75% of the people are going to come back to work, who's Bill Tessar? What does he know about people coming back to work? And so I could be wrong on that. And so less people come back to work and less people are buying real estate and more people have to sell to get their liquidity out and all these things that could push values down. I think that is probably optically the biggest thing that people are watching, right? And so listen, before the pandemic, we were up to 80% with 100% of rehab. And I know there were other lenders that were even tickling 90. The lenders that were tickling 90, decapitated. Like those loans were trading in the mid 80s. If you just think about it, if you had $100 million on your warehouse line, and $100 million would be a small mid-sized lender. If they had $100 million on their warehouse line that was valued at 102 on February 28th, and on March 7th, that is valued at 88, that's a $14 million swing. That they have to bring that capital in. They don't have that capital. Those loans get swept. So it's going to take a while. I believe it's going to take, you'll see some guys getting in there and putting their nose around. I call it like retrades, right? They'll advertise a higher thing. You'll get in and they're going to say that the dresser was yellow and your car had a flat tire and you had a Sears late in 1972. So we had to drop your LTVs rather than just being true to the market. But rates I could see start inking down. We pulled back 50 pretty quick when we saw that there was a pass-through opportunity. And what I would tell all of you is I'm having more conversations with new takeouts and new financing options that ultimately what that means is if we have more and that's a better price, we pass it on. This isn't a cash grab for us. We know where we need to be to operate profitably, and the rest is market. And so I see price coming back quicker than leverage. I see the bigger loans probably coming back, sooner than that. There's been some question about Rehab Pro. That probably takes a little bit longer because it is ROI.
Right.
But I'm just telling you all on the call, it feels better in my seat today. And for some of the people from our company that are on this call, they will tell you, I'm four-generation military family. It was guerrilla warfare. It was hand-to-hand combat, and we were fighting for every little stitch of everything for the loans, for our community, for our brokerage community, for our investor community. And it was, I don't like to use the word scary, but it was a challenging time. It feels a lot more open, and it feels like I'm seeing the sunshine come through the clouds a bit.
Awesome. Thanks, Bill. To take a break from questions, I thought it might be interesting to go through some of these poll results that we've been getting live throughout this meeting. So the first question was, where's the majority of your business currently coming from our brokers? So 59% purchase and fix and flip. And I think that kind of answers the question from a few minutes ago, right? Is there still opportunities out there in the market? I mean, if there was not opportunities out there in the market, we wouldn't get 3 out of 5 every requests for purchase or fix and flip, and then 41% cash out refi. And then what product are you getting the most requests for? 64% short-term bridge and 36% long-term rental. So I thought that that was interesting, interesting information to pass on. Bill, do any of those numbers, I know, sorry, I'm kind of going off the cuff here, but do any of those numbers surprise you that 60% of the loan requests that our brokers are seeing are purchase and fix and flip? Would you expect that number to be lower or higher?
I would say that number or higher. I think there's opportunities out there, right? Especially if somebody entered into the pandemic with the idea that they were going to get into this space and maybe they want to bail, so they're taking their chips off the table. They want to sell quickly. They're going to sell at a discount. I think there are opportunities to buy. We're seeing it. We see it right now, Ben. Our applications, the actual applications are up for us. Like the opportunities are higher for us. It's just getting the people in the right box, right? The rental doesn't surprise me. The rental market completely disappeared overnight and is slowly eking itself back in. And I think Wall Street's trying to figure out, like, there was some big aggregators originating for big investors that had 500 properties to 2,000, and they were doing those loans in the mid to high fives. Those things had like not just a discounted value, a obliterated value. They weren't worth anything. And so I think there's probably some lessons learned in there, and we're seeing that now, Ben.
Got it. Thank you for that. Let's see, what else? Do we have any other questions that came in? There was one question that came in live that was, do you have a gap funding resource for clients who are a tad short on the cash to close due to current lower LTVs?
We don't have that right now. I understand the question. Have not offered that. There probably is a market. Whoever asked that question, reach out to Ben. Ben, make sure you have your email. We'll follow up with you. I think there's an opportunity in the marketplace for that type of funding. We also talked about piggyback seconds. Before the pandemic, there was a lot of talk, right? So I'm making these numbers up, but if you lent to 80 and someone needed to go 85, you do it 80 first, piggyback 5%. Those piggyback seconds, there was actually a market for that. You could securitize that product and you could offer that. Yeah, the rates suck and the terms are horrible, but it's 5% of the overall transaction. And for some people, the cash was king and it made sense. I like the thinking around the question, and it's something we should continue to explore.
Got it. So we don't have any other questions currently in the chat. So if we want to open it up to live questions, if you have a live question, Gina, there's a way to raise your hand, right? Or to just ask a question in the chat. So if anybody else has anything that they're curious about that they want to ask myself or Bill about CIVIC or about the industry, please raise your hands now. And we'll give a minute for those to come in.
Yeah, and while you're doing that, Ben, one thing I'll just let everyone know, this is kind of more of a did you know, right? But we lent loans, we advertised loans to 10 million. I think the biggest loan we've ever done was like 14.5 million. We've done 78, I just looked this up because I was curious, 78 loans over the last few years, over 4.5 million. The bigger loans actually perform. We dropped that max to 5 to advertise, but if the leverage is low enough, and the file is strong enough, we'll still consider the bigger loans. We had a deal that is on my desk right now at the Strand. If any of you know anything about Manhattan Beach, the Strand homes are 12 to 25 million dollars. The leverage was very, very low. He's on the tail end of his rehab, ready to list. It's an absolute make sense deal. And so if any of you ever come across an absolute make sense deal, not one that you're trying to make sense of, but one that makes sense, but it's outside what you believe our guidelines to be, you pick up the phone call your account executive and run it by them. And we're going to consider, I mean, at the end of the day, if the loan is sellable individually or as a pool, we're going to find a way to get it done. Even if we have to shelf the loan for a few months while we work on that, we will do that. We have the capacity to do that. Additionally, while you guys are aggregating questions, if there are any. What I'd like to extend, if you found any value in this call at all, and you think it would be a good way to leverage your own database of customers, I'm happy to work with you if you want to set up something similar where you can get your customers on a call, and it could be you're the host, you would be in Ben's spot, and either Ben or myself would get on and offer the same perspective, so that you're doing that same partnership thing for your resources that we're doing for you. I'm happy to extend that if you think there's value in that.
Awesome. Well, it doesn't look like we have too many more questions coming in. We've been on for about 45 minutes. So I just want to personally thank everybody for their time, and thank Bill for coming on here and kind of explaining, giving you industry insight on what's gone on in the last 90 days, which have been pretty crazy. I want everyone on the call to know that we truly value our brokers, and it's an extremely important relationship for us. And we are looking forward to growing that relationship and closing more loans with you guys, providing more educational resources, whatever we need to do to be a better partner for you and help you expand your business. That's what we're all about. So again, there's going to be a recording of this. If you want to take a look at that later, you can sign up for Bill's future industry insight presentations. And if you have any questions about anything, please reach out to your account executive, or feel free to reach out to me directly. And with that being said, thank you, everybody. Have an awesome day.
See you guys.
Appreciate it.
Thank you.